Aloha, this is Kurt Nielsen, owner of eMortgage Hawaii, and this is my 2022 forecast for housing, mortgage rates, and the stock market. I think this is my 20th year of doing this, so let's just get started. I'm going to go ahead and share my screen and pull up some slides here. There we go. So this is our 2022 forecast, but before we head into the forecast, I want to talk a little bit about where we were a year ago in 2021. Kind of look at a recap. Let me get rid of this here. So our forecast last year for interest rates, we were expecting interest rates to rise quite a bit in the beginning of the year and then to recover and come back down into the fall. Actually, rates did rise sharply through March as anticipated, but really did recover quite a bit earlier than we had expected, gaining most of their losses back by late summer. On housing, we thought there was going to be strong demand and tight supply and would push home prices into the high single-digit percentage. That was a very robust forecast. And there are some people forecasting an actual drop, but the actual, we got into double-digit growth in housing prices. So a lot of this was caused by supply chain problems and labor shortages, but real estate values just really took off last year, even higher than what we had thought. But again, we were on the right side of the forecast in terms of feeling it was going to be robust, while some were actually looking at declines, which made no sense with the supply problems. So let's look at 2022. The Fed is really going to play the most important role in 2022. They're tapering their purchases of treasuries and mortgage-backed securities. They were buying about 100 billion a month in mortgage-backed securities. They're down to about 70 and still dropping. And they may even let their balance sheet run off. They have something like $7 trillion worth of mortgage-backed securities on their balance sheet. This plus rising rates that the Fed will almost has to hike rates quite a bit this year. And that could impact the equity markets and housing as well. So we expect the interest rates to be driven up quite a bit here in 2022, and we're going to talk a little bit more about that. Now look at the Fed voting members. We replace 4 members each year, and the composition of the Fed right now is much less accommodative than they were in 2021. And fighting inflation is the main focus, and this should have a negative impact on the stock market. As we probably know in hindsight, the Fed should have been hiking much sooner, but they mistakenly thought inflation was transitory. We've heard that so many times before. If you look at history, I think it's important to look at history as we look at the Fed actions coming up in this year. So let's go back to the 1970s with Arthur Burns. He completely ignored inflation, which was rising rapidly, insisted inflation was transitory. That sounds familiar. And year over year, inflation ballooned in his 2 years from 7% to 14%. Unbelievable. By the time he left in 1980, Burns remained steadfast that inflation was transient. Higher inflation caused mortgage rates to rise from 12% to 18%. Then comes Paul Volcker. He got handed over the mess from Burns. He hiked federal funds rates from 11% to 20% in just 2 years. Inflation dropped from 14% down to 5%, so it worked. Because inflation dropped, mortgage rates did decline from their peak at 18% down to 12%. 12% sounds bad, but it's a heck of a lot better than 18%. But as you know, there are consequences to the Fed's hiking rates. The S&P dropped sharply, declined 30%, and the tight money supply pushed the US into recession in 1982. Then along comes Greenspan in the late 1990s, same thing. Inflation doubled from 1.75% to 3.5%. Higher inflation caused mortgage rates to rise, not quite as sharply, obviously, but from 7 to 8.5%. But unlike Burns, Greenspan took history into account, took quick action and raised the federal fund rates by 1.75% from 4.75 to 6.5% in 1 year. So a pretty big move. And inflation did respond, dropped down to 1%, and then mortgage rates after the inflation dropped down to about 5.5%. And that actually sparked a pretty big refi boom because we had mortgages out there as high as 18%. But again, consequences. S&P fell 50% from the spring to the fall of 2000, and the US entered another recession. So now let's look at where Jerome Powell is. In 2021 and now into 2022, inflation has gone from 1.75% to 7.5% just this last week. Now, Powell thought it was transitory, but I think he's obviously changed his mind on that. So these higher inflation figures have caused mortgage rates to rise from 2.5% not too long ago. That was the third and fourth quarter of 2021, all the way up to now it's almost at 3.875%. So the Fed is currently tapering their purchases of mortgage-backed securities. They really didn't want to hike rates at the same time that they're tapering their purchases, but they actually may have to. They'll be done tapering in March and likely to begin hiking rates shortly thereafter. The Fed has talked about 3 rate hikes in 2022, might be more, and then 2 or 3 in 2023. Inflation and interest rates will continue to rise until the Fed really starts acting, and I think the time has come. So, but if the Fed can tame inflation, mortgage rates should drop, but may be much higher than they are today before they get inflation under control. So if we kind of recap the pattern here, so Burns and Volcker, inflation 7% up to 14%, mortgage rates rose, Fed's fund rate went from 11% to 20%, if you can believe that. But then they did curb inflation, it dropped to 5%, and then mortgage rates correspondingly dropped down to 12%, and we went into a recession. Alan Greenspan, same program, inflation doubled, mortgage rates rose, Fed's funds rates went up quickly, inflation responded and dropped, mortgage rates then dropped back down, but the S&P dropped 50% and we went into recession. So it does look like the same pattern is going to be holding here. We've jumped from 1.75 to 7.5% inflation. Mortgage rates have, gone way up in a very short period of time. We expect the Fed's funds rates to rise 1% in 2022. That should begin to bring inflation down. But I think mortgage rates are going to continue to rise until inflation drops. Then they should decline back down. We may get back down to the low to mid 3% range, which also means that if you're getting a mortgage right now, don't pay points, don't pay fees, because there's going to be a refinance opportunity in the not too distant future. So what do we expect on the S&P? Well, if history tells us, we should see a drop in the S&P, and the country may go into recession depending on what we do on stimulus and some other things. So let's talk about the wild cards. COVID is playing a major influence on monetary policy and the supply chains. Another major surprise in COVID could change everything. Who knows, another variant out there, maybe one that's more deadly. Additional stimulus is the wrong thing. It'll just fans the flames of inflation, would temporarily push the stock market higher, cause mortgage rates to rise even further, but just make the Fed's job of crowning inflation almost impossible. So the other big issue is the runoff on the Fed's balance sheet. If they hike rates and allow the balance sheet to run off, that could be devastating for mortgage rates. Remember, they're still buying about $70 billion a month of mortgage bonds. And this is the money that is coming from the payoffs of mortgages when people sell their homes, and they're just reinvesting it to try and keep the balance sheet kind of stable. But if they don't rebuy, then the balance sheet will start running off and mortgage rates will go up quite a bit. So even higher than what we're forecasting if they decide to do that. Stock market forecast. Stocks are just extremely expensive. The PE ratios are very high right now. Rate hikes should cause the PE multiple contractions, resulting in lower stock prices as seen in the past. So we're forecasting 10% plus or minus decline in major indices in 2022. Could be more dramatic than that. Who knows? Our interest rate forecast, we believe that we are going to see rates rise into the 4% range, up from 2.5%. If the Fed can corral inflation, we would then see rates head lower into the second part of the year and get back into that 3.5% range. So don't fear. If you're buying a home, buy it now because prices are going up and we can always refinance later. So that's our forecast for interest rates. Again, if you are getting a mortgage, don't pay upfront fees because there's going to be a chance to refinance. Our housing forecast, we think housing is going to remain strong in 2022, but not as strong as 2021. Demand may soften up with rising interest rates, but I don't think people should stop buying because we're going to get a chance to refinance those mortgages. It's more important to lock in the value of that property. The supply chain will improve, but still remain tight. So we also see rents rising above 5%, and that may push more people into looking at the benefits of buying a home. So our forecast is for a mid to high single-digit appreciation in housing. Some markets might be a little bit higher than that, especially here in Hawaii. And that's just a great wealth opportunity. So for those of you that are in the real estate business here in Hawaii, I just want to talk a little bit about what eMortgage Hawaii does in helping our realtor partners. We really are invested in your success. We have a co-branded marketing system where we create a professional property website for each of your listings. It comes with sign writers so people can drive by and text the sign and get a tour of that property, and then you get their phone number, so it generates leads for you right there on their phone. We do virtual tours for you, and we have a way of helping you on like Craigslist and some other websites to capture leads that you normally wouldn't capture. And we're boosting that website to 83 websites around the country. We have a TV channel called MoveTube that we feature your listing, where people can shop for property right from their living room TV. It's really slick. And with Zillow, we have a way of directing leads to you without you paying for them. So you should call me and talk to me about that. And then we have our mortgage app. Our mortgage app is co-branded with you, your headshot and your logo. And that way you can pre-qualify your client by sharing the app to them. And 7 days a week, we can pre-qualify your clients. So if you want our mobile app, download it from your app store. It's called eMortgage, EZ. Email me your headshot and company logo, and I will customize that app to be yours. And then you can actually market to your clients that have that app right from your mobile app. So if you got a new listing, you can alert them. So call me if you have an interest in some of the things we're doing with our co-branded marketing system. And I haven't even touched on half of the things that we do for you and your clients. So that is it. I appreciate it for you taking the time with me, and give me a call if you have anybody that you need pre-qualified. Thank you.